Good afternoon from DBS Asia Sparks Studio. I'm Taimur Beg, Chief Economist, wishing you a very happy new year, along with my colleagues, Senior Rate Strategist Eugene Leow, Senior FX Strategist Philip Wee. Happy New Year, gentlemen.
Happy New Year, Taimur.
The year has started with a bang. Lots to go over. We initially wanted to have basically a discussion on tariff and its impact on FX, which we will do. Philip will focus on that. But the tariff issue has been compounded by other issues. Inflation, with or without tariff, seems to be a bit of a headache. And Eugene and I will focus on that part of the story. So Eugene, the rate story. Philip, the FX story. I'll see you guys in a little while. Let me go over the basic macro picture first.
Right.
Thank you very much. So let's get going with the PowerPoint. But before we do that, usual housekeeping. You can ask questions during the course of this presentation by going into our Pigeonhole Q&A portal. Go to dbs.pigeonhole.at and type the password macro, or just scan the QR code that is on the screen right now. If I'm going over all of these things very swiftly, no worries. At least 3 more times during the course of this presentation, we'll bring back this slide to you. I would like to talk a bit about the tariff-related discussion, but I will put that toward the second half of my presentation. In the first half, I want to focus on the inflation rates developments that we have seen over the past few weeks, which have not only made US market watchers nervous, but that nervousness has actually spread over to the broader global economy and financial markets. And as I said earlier, I will then move on and give the podium to Eugene, followed by Philip, and then we'll come back and take some Q&As at the very end. So we've had a bumpy start to 2025. Typically, when I compare yield curve, I would show today's yield curve and compare it to something from 3 months ago, 1 year ago, and then show the movement. Because normally, you don't see yield curves move very violently within the span of a few days. But look what has happened lately. Since the beginning of this year, we have basically had 8 trading days, and there's been a discernible tilt and a shift up of yield curves, not just in the US, but in a variety of global markets. For your illustration, we have the US and the Singapore yield curve on the screen right now, and what you see very clearly is that long end has sold off substantially in both jurisdictions. Singapore, of course, always trades well within the US, but at the same time, the upward momentum in the long end is pretty palpable both in Singapore and the US, and it's not just there. If you read the weekly outlook weekly insights piece that we brought out yesterday, you'll see a full discussion that UK, Germany, France, Japan, everywhere we have seen an upward momentum in yield. So there's been a global sell-off in the long end of the spectrum. And particularly most dramatic is not just the comparison between now and the beginning of this year, but consider what has happened since the 17th of September when the Fed came out and made that rather seismic rate cut, 50 basis points, which frankly speaking, did not see coming. And now, with the hindsight of 100 basis points of rate cuts since then, the fact that the long end has sold off by 110 basis points is an absolutely major indictment of Fed policy and Fed credibility. It's not been good. The markets have not been impressed by what the Fed has done in the last 4 months, and it's actually said the opposite of what the Fed would like the market to say. The Fed, of course, would like the market to say inflation is tame. We don't need to demand large premium at the long end of the spectrum. The market is saying the opposite. Inflation is not tame, and we do need to worry about where the Fed goes in 2025. And it's not just unidirectional. It's not just a steady rate cut. It could be no rate cuts. It could be very little. And perhaps in the margin of scenarios, maybe even a rate hike. Any of those scenarios are very, very different from what the Fed was trying to guide the markets toward just 3 months ago, 4 months ago. And as a result, Fed credibility has been dented. The markets have gone off a bit of a strike in the other direction, and we have seen the long end sell off very sharply. Why? Is this because of nervousness around Trump? I think there is some grain to that development, but surely, long before 20th of January, without actually getting any visibility of Trump policy, it would be way too much for the markets to go in such a big sell-off. No, I think it's coming from a very different sector, and that is the age-old genie of inflation. Something that has been on a downtrend for a while, but seems like no longer in a firm downtrend. So the first chart I'm sharing with you on this issue is what's happening with core inflation and the manufacturer's perspective of prices. I'll bring back non-manufacturers momentarily. And there, as you can see, there's a pretty decent lead-lag relationship between what happens to core inflation, which is typically preceded by the ISM manufacturing price. 2020 is a very good example. ISM manufacturers started reporting very sharp pickup in prices from basically the middle of 2020 onward. Even in the middle of the COVID pandemic, it didn't really reflect in core PCE for about a good 6 to 9 months. But boy, oh boy, when it did, it soared exactly in the same manner and going even past that by the time it was 2023. And then, just as inflation was sort of, cresting at about 5% or so, core inflation, the manufacturers began to report a dip in price pressure, which didn't show up in core for a while, but then it came down pretty sharply, just as the ISM readings did. So what are the ISM readings telling us right now? It's telling us that inflation pressure is not abating any longer. It's sort of flattened out. In fact, you could say that the least amount of pressure that manufacturers faced was about 2 years ago. Since then, price pressures have basically stagnated, not really picked up in a meaningful manner. But now you're beginning to see exactly that in the inflation numbers. Core PCE inflation is stuck in the high 2s, nowhere close to the 2% that the Fed was so confident that we were on a one-way path to that journey, which was the justification for the 100 basis points in rate cuts. Now, let's not just talk about manufacturers. Americans consume goods, but they consume services much, much more. What's happening to non-manufacturing services producers with respect to price pressure, in my view, is equally, if not more important than what's happening to the goods price dynamic. And therein lies the even greater worry. This data came out just a few days ago. I think this is, again, spooking the market substantially, that the non-manufacturers are basically saying that input price pressure, the things that they pay for, is at a 22-month high. That's troubling. That is, again, telling you that there's some incipient price pressure in the economy. The economy is certainly not slowing, labor market is certainly not softening, and price pressure is certainly not abating any longer. Speaking of labor markets, let's talk a little bit about job creation. As some of you who follow markets closely know, that we sitting in Singapore on Saturday, those sitting in the US on Friday, saw some blockbuster non-farm payroll numbers. We saw some dip in job creation in the mid to the third quarter of 2024. That was enough for the Fed to start worrying about growth and unemployment, and that again became a big justification for rate cuts. Mind you, although the Fed was saying that inflation is heading toward 2%, operating word was heading. It was not already at 2%. So inflation was a prospective call. It will go there. What was going to be the driver? The driver was going to be weakness in labor market, which was something that the Fed thought it was seeing in a fairly sizable manner in the economy in June, July, August of 2024. Well, that's turned out to be pretty wrong as well. Since then, non-farm payrolls have steadily nudged up, and the last couple of data points have been extremely strong, way above expectation, 250,000 jobs being created. And the overall dynamic, whether it is public sector, private sector, everything is looking very, very strong. Beyond the non-farm payroll, if you look at unemployment rate, if you look at wage numbers, everywhere we're beginning to see, again, signs of sustained strength in the labor market. We've got unemployment rate at about 4.1, 4.0, wage growth also close to about 4%. There is no major sign of this market weakening. So there are three sources of inflation that the market is worried about. One already is beginning to roil the markets, which is the strong labor markets data. Second, coming in a week's time, watch out for that, tariff, and perhaps coming in a week's time as well, tightening of immigration. So between tariff and immigration and strong labor market, how can the market be comfortable, especially when there is so much debt issuance to be done? Some of it is short duration, some of it is long duration, and hence the sell-off. To me, that is the main driver of what's been going on. And I think when you hear from Eugene, who will go over more technical aspects of this, you will probably conclude with our view that the pain points are by no means over. There's more sell-off coming. Now, inflation worries and rate sell-off on its own does not have to be a major source of systemic risk. Stuff like this happens. Some data come out, it's better than expected. financial variables behave in one direction, and sometimes the other developments happen. But what is happening right now is it's not just a question of inflation turning out to be strong or the cycle turning out to be strong. It's the fact that it is all happening at a time when debt ratios are alarmingly high and interest payment is already substantial. The US Treasury, for example, last year paid well more than $1 trillion in interest payment only because of the very large debt GDP that the US has. Those numbers are not coming down anytime soon. Trump is focused on tax cuts. There will be, I'm assure you, regardless of all the talk about DOGE, not much by way of spending consolidation. Fiscal deficit will remain in the 5-6% of GDP handle, if not higher, and the interest rates as they're going up will create a certain amount of problem for the US government in terms of the huge interest rate bill, in terms of that crowding out from other essential spending needs, and the US is not alone. If there is rate sell-off happening all over the world, look at these numbers, whether it is Japan or France or China or the UK, for that matter, even Brazil, debt ratios of 100% all over the place. Now, there are a couple of countries, India would be one example, Germany would be another example, where debt ratios are not that high, but they're not low by any means either. Among all the major markets in the world, and by major, I'm defining them by population, market size, GDP, you have debt GDP ratio well over 50%, in most cases, well over 100%. A world of debt with a mountain of interest payments. Now, the story is, of course, not just concentrated on the fixed income side of the market. There's significant FX dimension as well. Philip will go over bilateral rates. He will go over some of the tariff scenario impact on FX. I don't want to go there. I just want to point out that when you think from Asia's perspective, you don't necessarily only think about the external shocks that are coming to hit the region. You also think about the buffers the region has, regardless of the source or the type of shock. If there's going to be a crunch in liquidity, if there's going to be a rise in interest rates, can you absorb that? Well, the way we measure that shock absorption capacity is through this measure called gross external funding requirement. We take any given year's current account financing needs, add it to the entire bond financing needs in gross terms for the year, and that brings us to the entire year's external funding needs. Instead of looking at this in dollars, because they vary by the size of the country, we try to scale it, and here the scaling variable is their reserves. So how much funding do you need in a year, and how much that is relation to the reserves that you have in the central bank's balance sheet. Now, two observations from the chart that I have for you, red bars 2013, black bars 2015, 2025 projected. Observation number one is that compared to 2013, and we picked 2013 because that was the taper tantrum year, buffers have come down a lot. China, Korea, Vietnam, Philippines, everybody had far more ample buffers back in the taper tantrum days than now. Their current accounts are not that favorably inclined anymore, and their reserves are not as ample as they used to be. Now, you could say that there are a few countries where things have actually gotten better. Indonesia, India, and Thailand come to mind. But by and large, the ratios are still small. You could argue China's ratios are smaller today than they were 12 years ago, but they're still much larger than it is for India and Indonesia. So I would think that the INR, IDR, CNY complex remains quite vulnerable to a major sell-off from tariffs. And then we have to basically take Trump at his face value till 20th of January comes around. But my view is tariffs are going up, and FX markets already have reacted to that, but there might be more reaction coming because some of the time actual news gives you some finality as to your position taking or position liquidation is concerned. All right, I have a very elaborate table on this screen. I'm not going to go over it at all, but I welcome you to download our PowerPoint from our website or reach out to us. We'll make this information available to you. What you have there is a series of estimates from various bipartisan or nonpartisan bodies around the United States on the impact of an across-the-board 10% tariff or 60% tariff on China on the GDP of the United States. The question is, will these tariffs be disruptive for the US? And if then they are, what would that mean for the whole world? And the short answer, if you were to parse through the various columns of this table, would be that a 10% universal tariff will probably subtract 50 to 60 basis points of growth from the US. That seems to be the middle of the road estimate right now. So if there were no tariff in 2025, if Trump goes ahead with no tariff at all, I probably will expect the US to grow by about 2.5%. But with the tariffs in mind, I probably have expectations set around 2%. Now, I think it's very important that we spend a couple of seconds on this particular slide. The history of the US with respect to tariff is a rather volatile one. There was a time when the US was characterized by very high tariff. Back in the late 1800s, President McKinley imposed very sharp tariff. Average rate on dutiable imports was 50%. Average rate on all imports was about 20%. The famous, or rather infamous, Hawley Smooth tariff of the 1930s raised the average rate on dutiable imports all the way to 60%. But at that time, average tariffs still were about 20, so there were less dutiable items under the tariff umbrella. Now, compare that to that, the 2018-19 tariff is like not even a serious tariff war, because there we had average duty rate on dutiable imports about 10%. And if you took the entire spectrum of all products that the Americans import, average rate was like 2.8 or 2.9%. I've rounded it up to about 3%. Now, some of the things that we're hearing from Trump's camp, and let's be very clear, Trump's camp is a disparate one. So you would have the Peter Navarros of the world and Lighthizer of the world talking about rather extreme numbers. There might be others like the incoming Treasury Secretary who might have a slightly more nuanced and middle-of-the-road view on these things. But if we were to go with what we're hearing, it seems like they want across-the-board tariff 10%. Some people even say 20% for all imports out of the U.S. This will constitute a mega shock to the global economy, starting with the U.S., but it'll be felt everywhere. Inflation, growth, job creation, everything in our view would be affected negatively by it. I'm not trying to take a biased view here. I'm going with the vast majority of economics profession and professionals' model-based estimates on this issue. And that seems to point to very clearly a large increase in tariff would be negative for U.S. and global growth. What are the various channels through which the economists estimate these things? Well, for the near term, the two channels in which most models try to suss out the impact of tariff is one through the impact on near-term price level. The other one is through near-term jobs or labor market dynamic. On the price level, it's a straightforward intuition that feeds into most econometric models, which is inflation pass-through from the tariff, goes straight from exporters to importers and then to consumers. You could argue in 2018, 2019, the proclivity of exporters to pass it on to importers was not that high, and for the importers to pass it on to consumers was pretty low. Things might be quite different now, given geopolitics, given the post-COVID price-setting mechanisms and price-setting behavior. We might see a much faster pass-through now. So that's one. And it follows from there that you will have a string of reactions through the economy that, again, can be put in as assumptions in an econometric model of the impact of tariff on growth. One would be, if indeed inflation picks up, and the Fed already was worried about the inflation issues given that service sector is so strong, it might have to even hike rates, tighten monetary policy, or keep QT going. So even if don't hike rates, talk hawkishly, let QT continue, tighten liquidity. All of those things be fairly negative on the market sentiments and the economic outlook. On the longer term side, there are some rules. Some of them are almost like tautology. If you put tariff and imports cost more, but you still import those things, by definition, you have less money for other things, and therefore you will consume other things less. That, I think, is almost like tautology, as I said earlier. But from there, it also follows that if you put tariff basically to protect your domestic industry, there's less competition, and we have ample evidence from time series panel studies of developed economies, emerging economies, present days, past times in the 70s and 80s. They all point to the same thing. If you put high enough tariff and discourage competition to create domestic jobs, you also create a very, very lackadaisical and complacent corporate sector, which then sees competitiveness, productivity erode, and that then hurts your long-term growth and jobs potential. So I am pretty unequivocal in my view that if indeed Trump goes ahead with substantial tariff, it not only will have destabilizing impact on global rates and effects on already a rather charged and volatile situation, but as far as impact on growth and inflation in the near and the medium term are concerned, in my view at least, results from various studies are pretty clearly that for growth it's negative, for inflation it's likely to ratchet it up. All right, I'm going to stop right there. Just to remind you, on the screen, again, the QR code, dbs.pigeonhole.at for you to go and type in the passcode macro. If you want to ask us any questions, yeah, right there. You can see it. And guess what? Eugene is here now to take on from me. Eugene, I'll give you the clicker. And I'll see you during the Q&A session later. Thank you.
Move very quickly. So one of the themes that is playing out right now is that inflation could have bottomed. Right? So we have had a very good run of inflation across many parts of the world, have come off over the past 2 years or so, and are now approaching levels where policymakers are a lot more comfortable. Right? So does it mean that the risk is now to the upside? Right? That's theme number one. The second theme would be bond vigilantes. So we saw a bit of it in the UK. It's sort of recurring right now. And I think a little bit of that fear could be appearing in the US Treasury space as well. So bond vigilantes is something that has not really existed in the DM space for some time, especially not for the very strong large economies such as the US or UK, right? So, but I think it is increasingly relevant when the amount of debt that governments across the world have been taking on over the last few years. So if we will need the increasing premium that gets factored into the long-end government bond yields, and it will keep coming back, right, until there is a sustained solution to it, which right now seems very elusive. Now, the third theme is, could there be a higher neutral for US dollar rates and for interest rates for many parts of the world, because they tend to be correlated, right? So if we have structurally higher inflation, if we require higher term premium for various kind of risks that did not exist a few years ago, then perhaps the neutral rate would have to be a little bit higher. And of course, very important for the next 4 years is under the Trump presidency, how will this policy shape out? And just as importantly, how will the other parts of the world, including Asia, respond? Right? So just to take stock of how yields, local currency, government bond yields have moved over the past year plus or so, they have generally gone up. Across the G10, 7 out of the 10 economies have cut rates, but you see most of the 10-year yields are significantly higher than they were about a year ago. Stresses in the EM, we see that mostly not within Asia, but in other parts of the world, the stress is there. Within Asia, it's more mixed, but there's really a very nuanced picture for each economy. So in terms of stresses, just zooming down into Asia, right, the y-axis, we have performance of the currency. Right, so anything at the top means currency strength, and it's just the US over there. Right? Everybody else is struggling against dollar strength. It's not that easy to overcome. And for the rest of the world, right, within Asia, generally you see currency weakness. So that is one source of stress. Now on the rates front, it is more mixed. Right? So similar to the previous chart, some economies where we have the rates that are more correlated with the US, like Singapore, Hong Kong, yeah, this makes sense. And Japan, which they are having still maintaining the hawkish stance, then yes, rates, the bias is definitely higher together with the US. But for the rest of Asia, especially those where you have more difficult domestic economic conditions like China, right, where there's a greater need to support the economy and then PBOC is a lot more aggressive, then there's a divergence going on. Right? So the US rates, even though they have been going higher, CGB yields have been going down until the past week or so when there's been a bit of a pause because some of these rates might have gone too low too fast. So stresses are definitely there. And now we just want to highlight within the dollar rate space what kind of shifts have happened. So the chart shows you a breakdown of how the different drivers are impacting the direction of 10-year US yields. So one of the biggest shifts, right, in spite of all these rate cuts, we have 100 basis points of cuts, but yet it is the pairing of policy rate expectations that have shifted a lot. So just a few months ago, the market was looking at maybe 3-4 interest rates cuts this year. But fast forward to right now, we are pricing in just over 1 cut. So that's been pared down a lot. And the second point is that inflation expectations have also started to build up. And then another large factor driving higher yields would be term premium, right? You need to be compensated for the uncertainties. Plus, term premium also captures all the economic optimism that comes in. So think about it. If there's nothing seriously wrong with the economy, and the Fed has already delivered 100 basis points of cuts, accordingly, recession risks should be even lower now than they were a few months ago. Right? So these are what have been driving rates significantly higher over the past 3 months. Now, in terms of pricing, right, have we overshot to levels look fair? So we know that the Fed has adjusted its outlook on rates. Right? So in December, it shifted out the dot plot. Now it is on the red line on the chart to the left. It's quite a bit higher than its September's forecast, which was a lot more downbeat. So if you have higher inflation forecast, you have higher GDP forecast, it makes sense that policy rates should also be higher. Now, the market is even more hawkish, right? So we're looking at a terminal rate of about 4%. Now, 4% is very, very high, right? Based on the recent 15 years or so, right? So, which would make sense if the US economy stays strong, inflation expectation stays lofty, and nothing goes seriously wrong, right? So the same picture is also shown when we consider 10-year US yield levels. So I've bucketed into 3 different segments. And for me, anything above 4.5% represents strong growth, a lot of optimism about the US economy. So the question is, now that all these things are reflected, and then there's also a fair amount of premium on this Trump trade that's been running on the fiscal dynamics, inflation dynamics, could these have gone a bit too far, and then a bit of a pullback could be imminent, right? But longer term, I think we have to think about the structural issues, right? Fiscal deficits, how durable are the tariffs, what kind of pass-through are we going to get, the immigration policy. So all these remain to be seen. It's just that in the short term, rates have run up quite a lot. Now, I'll just go through some of the more interesting economies and rates over the next few slides. So for Euro rates, if you recall, within the G10, there are a few economies that face more downward pressures on their economies than others. So that could be Canada, New Zealand, Europe is one. Right? So Europe's challenges are structural. And if you compare now to the crisis that the Eurozone had in 2010, 2011, there's a difference. Because this time around, it is Germany and France that had political challenges. And if you look at the economies, there also are structural growth issues over there. So if you combine these two, it means that the economy is already having issues, and then this comes even before Trump comes into power, and then there could be additional stresses that come to the economy. Right? So the key takeaway over here is that the yield premium of the US over the Eurozone is likely to be there for some time. It won't be so easy to dissipate, right? Because you need some material changes, right? So US is willing to spend, but Germany needs to be able to step up, and it's not clear how this can happen easily. Right? And then the main pillar of support in the end is still be the ECB easing, which is the default path. So next up, China. So China has been facing challenges for quite some time. So the property overhang will be there, and the PBOC's blitz over the last few months as they become more proactive. We saw cuts to short-term interest rates, borrowing costs. There will be more to come this year. I think the issue then lies with the right-hand side chart on the longer-term rates, right? 5 years, CGB, IRS, 10-year. These kind of interest rates have collapsed to multi-year all-time lows. I think at its lowest, 10-year CGB yields are around 1.5%. So I think the issue comes with, is this level of pessimism warranted, right? Because some of these yields, if we think about the potential response from the Chinese authorities this year, they do have a lot of room to support the economy. So in which case, I think that interest rates, especially the long end for the onshore, seems to be a little bit low. It could be some scope for retracement higher in the short term. Next up would be Indonesia's interest rates. So Indonesia has a structural growth story, but the challenges always lies on the external front. And whenever we have the twin challenges of strong US dollar, high US yields, it becomes more difficult for Indonesia's interest rates and for policymakers to try and keep the rupiah stable. So the right-hand side chart shows you pressure on the rupiah. So it has really ratcheted up over the past few months as this Trump trades run and as more and more people jump on the bandwagon that the US is exceptional. Right? So against this kind of backdrop, BI has opted for prudent monetary policy. So in which case, scope for cuts become a lot more constrained. Now, if you want to think about the longer term, like the 10-year tenor, then it becomes an issue of value, right? Because if we look across Asia, not just in Indonesia, you will find that the additional spread over the US Treasuries has been low for quite a few years. Now, part of it could be due to the fact that Asia could have better, stronger fundamentals now. But if the US yields do not go down materially, then it is difficult to see a very big rally in Asia local currency government bonds. So we have to be a lot more opportunistic. Now, what about India, the other big growth story, where we have very stable fiscal and external dynamics, and we also have rates on hold for an extended period. But now that there is a change of leadership in the RBI, and now that there's some growth concerns coming in, we're wondering whether they could open up some room for easing. So in which case, there could be scope for some steepening ahead. Now, in terms of the unique part about INR rates is that recently it has shown very little beta to US interest rates. Now, that's great, right? Because otherwise we have highly correlated markets. But in which case, local dynamics are very important to derive where India yields are going to go. So we think that as a diversification kind of thought process, India rates are quite interesting. So this will be my last slide. And I guess the takeaway here is that we do have a fair amount of things to monitor, right? The US economy, is it going to still be as resilient? How is it going to deal with sticky inflation? How our bond market, bond vigilantes, is going to react? And then what are the policies that will come out when Trump comes back in? Right? And then how will China respond? Right? Will it be more forceful if some of the policies that the US unleash is highly unfavorable? Right? So it would be an interesting year. And before I hand over to Philip, I would just like to highlight to people that you can always ask questions, and then we'll address them towards the end of the session. All right, Philip, over to you.
Thank you, Eugene. Thank you, Timer, for setting the tone. I'm going to cover the FX. So let's start out with the US dollar. US dollar has really been strong. We don't expect it to fall like it did in the first year of Trump's first term. Okay, in fact, we think that it has scope to continue rallying in the first half of this year. Towards the end of the presentation, I explained to you why we are cautious in the second half for the dollar. Okay, the chart also shows that the dollar index is really more volatile during Biden's term because of the Fed's fight against inflation, which we still think is still ongoing. And the other two reasons is that US is still performing much better, more resilient than economic stagnation in Eurozone and disappointing Chinese economy, as seen, unlike in 2017. And also, last but not least, Trump's tariffs are coming at the start of his second term and not in the second year of his first term. So we still think that the Fed matters greatly to exchange rates, especially to G7. What I've done here, I've mapped the currency, the dollar's performance against the 10-year yield. I'm not even using, the yield differential, to show you, I think, the impact. Well, for currencies like Europe and the Canadian dollar, the dollar has headed to above 2014 highs quite significantly because their economies are weak and they have a more aggressive rate cut outlook. The middle column, we also see the dollar higher against last year's high for sterling and the renminbi. But I think in this situation, their central banks, while they have a rate cutting bias, but it's not as aggressive as the previous two that I've shown. And in the third column, interestingly, the Malaysian ringgit and the Thai baht, the dollar is still well below last year's low. Generally, these countries do not have a rate hiking or cutting outlook, pretty stable interest rates. And they are also seen as beneficiaries of the China Plus One strategy. But nonetheless, there should be little complacency for these countries. One big change is Trump's threat to hit BRICS with 100% tariff. Okay, Indonesia became a full member in January. Malaysia and Thailand are partner members. They are also among the top 15 US trade deficit partner countries, okay, who also promote trade in their own currencies and in non-dollar currencies. So there's a need for, for caution to watch how things develop in Southeast Asia going forward. Okay, let's come to individual countries. Of course, we have to start with the renminbi. I think this time around, for now, we are expecting, yes, the dollar to head up against the renminbi, but at this point, we are not projecting something like what we've seen during the first term when China was hit with tariffs. Okay, we've spoken with our Hong Kong colleagues, who shared that, China probably learned from Trump 1.0 when it offset the tariffs with currency depreciation. But that led, Trump to label China a currency manipulator. And moreover, this time China is more prepared. I think in the sense that since fourth quarter last year, they have been pushing for stimulus and they have been moving towards boosting domestic demand, to counter the external pressure. And also, I think to be more, vigilant in promoting a basically stable exchange rate policy going forward. Okay, but nonetheless, we still need to watch the developments, especially as to whether the Trump administration will be more nuanced in terms of implementing tariffs this time around. Okay, next, Indian rupee has certainly caught everyone's attention. Dollar India is been rising rapidly in the upper half of its channel. We expect it to hit the top of the channel before it stabilizes. Okay, so India has a new governor who probably would like to pursue growth-oriented monetary policy, as well as less rigidity in its exchange rate management. Okay, but we have also noted that India is a founding member of BRICS, but India does not support, the creation of an alternative BRICS currency or support any other currency to challenge the dollar's dominance. But nonetheless, India still has a wider trade deficit during Biden's term compared to Trump's first term. Okay, so next, okay, the Australian dollar has been in focus. It's coming to a new low. We think that it can trade into a 57 to 62 cent range. The main story this quarter is that the RBI is becoming more confident about inflation hitting target, and therefore, he could possibly join the global easing cycle next month in February. Okay, so RBI, like many central banks, also consider the Trump tariffs as negative to Australian economy through its trading partners. Okay, most of Australia exports, I think some 70 to 75%, hit to Asia. Okay. At the same time, we've noted that according to the CFTC data, the speculative positioning for the Aussie dollars have turned from net long to net short. Okay, finally coming to the Sing dollar, we have briefly seen dollar Sing dip below 130 in September into the Fed's 50 basis cut. Sing economy was also doing pretty well in the third quarter, and inflation, was sticky. But since then, the Trump trade has brought the dollar higher. Sing economy has also sort of cooled, and along with it, Sing inflation, especially core inflation. Okay, so the Fed has turned cautious on cuts. Asian currencies have sold off as a result. But nonetheless, we think that after this sharp rebound, dollar Sing could be confined in that 134 to 139 range that we have seen during the first during the tariff year in 2018-19. Okay, another reason why we think dollar Sing will not fly up unless we get into a global recession is that the Sing near, according to our model, has dropped from the top to the midpoint of its policy band. Okay, so our view is that the MAS will probably ease policy by reducing the slope in April. Although, we think that markets also think that there is a chance that they may move in January. But as far as we're concerned, even if they do, it's likely to be a non-event because of the move in the Sing near from the top towards the mid point of the band. Okay, lastly, to sort of explain why we did not extend the dollar's rise beyond the mid-year is that we also noted that the US has reinstated the federal debt ceiling on the 1st of January this year. So starting today, over the next probably 9 to 10 days, Janet Yellen has estimated that the debt limit will be hit, before pushing for a continuing resolution. However, this does not mean that the dollar will fall off the cliff anytime soon, because it's been estimated that the Treasury has enough cash and extraordinary measures to avert the default, a few months beyond the first quarter. Okay, but nonetheless, longer term, I think most people still think that dollar is structurally weak. Okay, just like Trump's tariffs implication on inflation, could keep the dollar strong. But at the same time, we also, at some point, will need to deal with Trump's tax cuts and its fiscal implications, for the US dollar. So with that, I thank you. Okay.
Right, thank you very much, Philip. Lots coming. Let me ask you a question on this tariff matter. So you saw earlier I had that funding requirement chart where we showed that INR, IDR, CNY could be subject to pressure because their funding requirements are not insignificant. But at the same time, they show that, at least for the case of India and Indonesia, it has gotten better, relatively speaking. And there are other currencies and jurisdictions in the world. We just don't exist in Asia. There's Latin America, Eastern Europe, Middle East. So if you were to look at the entire spectrum of global FX rates, does Asia come across as particularly vulnerable?
At this point, I think it's certainly something to watch, but I don't think we should press the panic button just yet. Sometimes I feel that what you just described it's like a sort of mini Asian crisis. So, and I think that's something that is natural because as far as the tariffs are concerned, they're broader in scope, and magnitude. So there's always the worry that is negative for growth and positive for inflation, especially for the US. So it's like a double whammy, So nonetheless, those risk metrics that you brought up will be very useful when, let's say, we get a situation towards the end of the Trump's first term, where you're going to see the impact on growth, but especially one that leads to a global recession.
Right. Philip, I started working on those things. I mean, we do this every year, but this year's analysis was done. I was not even thinking about tariffs. I was thinking that just the very big wall of debt maturity, the big refinancing dollar funding needs, combine it with QT, combine it with relatively high interest rates. I didn't know whether the Fed was going to cut or not cut in 2025. That even if Harris were to become president, that 2025 could be a year when the dollar actually does not soften a lot because of all these other extenuating circumstances, particularly dollar liquidity. So I want to bring that issue with you, Eugene, that in the last 8 working days, I mean, that's all we have had in 2025, and already we have seen some pretty sharp pickup in yield. How destabilizing can this be for financial stability around the world?
I think the issue here is that when we have the largest, most liquid market, and it is supposed to be risk-free, start to move in very violent swings, then it becomes a problem, right? Because when we look at the bond market, right, we are probably, if we look at over the last 20 years, we see bond market rallying when there's a big crisis. But now we're worried about the opposite. We're worried about the fiscal deficit, we're worried about debt, we're worried about inflation. So the sell-offs hurt because there's mark-to-market on the balance sheets. And then there are the ripple effects across the rest of the world, which is very correlated with the US. So there are definitely concerns over there.
Right. As you know, both you and I have been discussing this issue about financial stability in the US. If there was going to be a fairly benign rates cut cycle, then issues like credit card loan, auto loan, some subprime mortgages, leverage loans, private debt, we would think that even the ratios are a bit on the high side, it may all work out. But now, again, we have to think about those things. If indeed we're going to have 10-year going toward 5% and 30 years well north of 5%, could be an issue.
Yeah, there's definitely tightening going on, right? Because the borrowing costs are not just tagged to the Fed's rates, where it's like 1 month, 3 months. When you look out across the curve, you're looking at borrowing at 5-year, 10-year, or 30-year perpetuals, right? Costs have gone up substantially, right? So these will have a breaking impact on the economy. It will not show up now, but it could show up a few quarters down the road.
On the credit space, if we leave the US and think about Asia, hard currency credit space, do you have any worries? Because I know the spreads are pretty narrow and nothing looks really scary right now.
Yes, primarily it's because there's a lack of supply over the last few years, right? So there's been an adjustment in the markets, tilting away from China into the other parts of the world, but the gap is quite difficult to fill. Plus, moreover, we have a situation where US treasury yields are very, very high. So there's also this tendency to fall back onto local bonds, right, where the financing cost might not be that high, right? So there are these dynamics to consider. But currency weakness in Asia is an issue, right? Because there's a repayment area to consider.
So even from the rates angle, we're looking at the FX space first and foremost for source of volatility. More work for you, Philip.
All of us.
Always. Let's put up the pigeonhole screen question on the screen. The first question, where would the demand for longer end US treasuries come from, considering China is reducing its purchases?
I think there is always this worry that's persistent because China is a very large holder of treasuries, right? And then what happens if they no longer want to hold it? But in the end, it is part of an accounting shift, right? Because if China has the surplus, they have to deploy. Now, if the surplus shrinks, it's either somebody else has the surplus and have to redeploy.
And the surplus has been shrinking.
Yeah, and then but it just goes to somewhere else, another economy, and then they too will have to figure out how best to allocate the reserves. And if the entire surplus from the rest of the world shrinks, they don't want to sell to the US or the US don't want to buy stuff, then the surplus within the US grows. So it will just mean that there will be someone else in the US, in the private sector, who will have to hold the debt. But it's just a shift, right? So,
And no shortage of those people right now. Plenty, right?
yeah. And some of these investors might be more discerning, which could account for why yields have risen so much. Because private sector, we probably have more stringent rules. So it's just a matter of premium, but demand will shift.
You and I discussed this. I mean, this question has been coming up to us in many live streams and within our internal stakeholders as well.
Yeah.
I think last year you helped me put together this chart. I think I even showed it in one live stream, which was the holder of US Treasuries by jurisdiction and institutional investor. And we see that among pension funds, asset managers, insurance companies in the US, long duration demand has been substantial.
Yes.
And any time 10-year or even 20-year goes over 5%, there's a lot of buyer coming in here. Philip might want to add something to
Yeah, I just want to weigh in on the discussion. I think from my side, when you look at the data, China's reduction of treasury holdings have sort of been offset by UK's increase in treasury holdings. That's one. Secondly, when you look at let's say Trump's threats on tariffs for countries that threaten the dollar hegemony. So I think going forward, it'll be interesting to see if this would also initiate a change in the behavior of these countries, or they'll just ignore it and continue to push for de-dollarization.
Okay, expand on that a little bit. So are you thinking gold, crypto, and non-USD assets?
I'm thinking that, Trump is looking for a commitment not to, undermine the dollar.
Weaken the currency.
Yeah, so I think countries holding, more dollar treasury holdings could, be a possible signal going forward.
Right. I mean, look, if you are yielding north of 4% or 5%, I don't think it's a very tough sell. There will be many countries, central banks and others who would be saying, fine, we'll pick up some treasuries. Default risk of the road. Okay, this question, maybe Philip, we start with you on this one. Does news on Trump team potentially doing gradual tariff hikes change the narrative on inflation?
Definitely, seen as dollar positive, because dollar has been rising on the fear, that tariffs will be aggressive, in scope, magnitude, and and inflationary. So, but we have also seen that whenever this a more nuanced tariff approach comes, the market is very quick, to sell the dollars. Okay, but then again, we have to be mindful that Trump's term haven't even started yet, and this will still be pretty much a lot of push and pull factors, okay, leading to volatility. I like to look at this discussion like the Fed's rate stance. How a shift in the Fed stance could result, like right now, the rate cuts becoming more cautious, and it helps the dollar to move up. So it's similarly, tempering this stance will also help to stabilize the dollar's rise against many currencies.
Right. So Philip, in my view, that's the optimistic scenario. I am not feeling very optimistic. US economy has been doing pretty well. I think the people who have funded Trump's campaign are very wealthy people who have made a lot of money in the stock market boom. None of these people are feeling insecure that we need to be gradual with tariff increase or we have to be gentle against our counterparties. My feeling is that independent of whatever has happened with the curve steepening that Eugene and I stay up late at night about, in this camp, there is no worry about these things. They think it's an exceptional time for the US. They think they can push US agenda, which is, let's see, let me get this right. Push up tariff, bring investments in the US, create American jobs, and then see growth go to 3% forever, something like that, right? And the tax revenues will even bring deficit down. That's into the narrative. I don't think that is a short-term narrative. It's something that would have to play out over multiple years. My fear is that these people who are advising Trump and who will be mostly dominating this cabinet would want to keep high tariffs in place, not as part of a negotiation and the China will buy lots of things and will lower the tariff. It's more like this is here till midterm elections 2026. There'll be no change in strategy. And if growth keeps on staying decent, we think that this is helping us.
I think generally I wouldn't disagree. I mean, it's something that I've been thinking about as well. I mean, it's just like how de-risking and decoupling eventually brought China to its current state, so becoming less important to investors globally. So that's why the BRICS tariff is interesting to me, because now it could be addressing China's response to US, telling the world not to
expand on the BRICS tariff for a second.
Correct. So it's the China +1, right? So it's like going transshipment to Vietnam, which I think is unfinished business from Trump 1.0 as well. So, so if that plays out, then I would say that we have to be wary of what we have seen in the late 1990s. So where a strong dollar policy, right, has sort of upended the Asian miracle after I would call that the Japan +1 strategy.
So, Eugene, you heard Philip earlier saying he doesn't want to entertain the Asian financial crisis scenario. He just brought it back in. Excellent. Great. All right. Let's take the one last question. We're running out of time. Thank you, Philip. It's more or less the same vein of what we have been discussing so far. I'm just waiting for the screen to refresh. Well, while it does, let me read the question to you, Eugene. Seems like rates would remain high, but would US dollar currency have any room to weaken? Well, actually, it's more like a Philip question. Considering fiscal deficits and unknown Trump spending plans. So what is the bear case scenario for the US dollar? We keep on talking about the bullish scenario.
Okay, I would say that the bull case is actually Besson's 333 agenda. So if we can achieve that, then I think that will set a very challenging stage for the world, especially given Trump's agenda for reshoring, and basically to get, investments to stop investing in outside of the US and to come home.
Anything to add, Eugene?
Yeah, I guess the issue here is that if the US gets into some economic issues, which is like post-GFC, then you get a chance for EM and Asia to really shine.
By that you mean financial stability issues or just
economic slowdown, like any kind of things that removes the exceptionalism from the US would actually be very helpful for Asia. But if 333 gets achieved, that means that structurally the US will also be very, very strong. So we'll be looking at a structurally stronger dollar, right? So that is something that we got to keep in mind.
My focus remains on the financial markets. I mean, if you look at the last quarter of a century, US economy has been tripped up basically by financial stability things, dot-com bust, 2008 financial crisis, and then the pandemic. So we need big shocks. Short of that, US exceptionalism just might stay and Trump just might get away with some of his rather outlandish policies, at least in the near term. Anyway, that's our first salvo for the year. Thanks for joining us in this January Macro Insights live stream. Eugene, Philip, thank you very, very much. We'll come back to you next month again. Until then, everybody, stay safe, stay healthy. Bye-bye.